Now what? Thank you for joining me on this great Tuesday. I'm Dr. Catherine Gilstein, and I am looking forward to empowering you with information about financial literacy and economic empowerment. I will continue to post on the second and fourth Tuesday of the month, but I will be adding to my podcast since I have such great interviews lined up. Today, I am joined by Aaron Smith, who is co-founder of Savi, and we are going to discuss student loan debt, how much to take, how to pay it back, and I think we're also going to get into some employer benefits that are available for tuition assistance. Aaron, thank you so much for joining me. Tell us a little bit about your background, and then we'll get started.
Great. Well, first off, thank you for having me. As you said, I'm the co-founder of Savi. We're a student loan benefit company that helps hundreds of thousands of students and graduates figure out their student loan debt and get on a path to paying that back. Um, I'm a lawyer by training, so went to law school. Actually took on a fair amount of student loan debt myself, so I went through that
Mhm.
experience of paying it back. Um, I had also started a nonprofit called Young Invincibles that worked on basically expanding economic opportunity for 18 to 34-year-olds. So how can we make sure that this generation does succeed economically, and what policies do we need? So I did a lot of work around how to improve the student loan system, expanding programs like income-based repayment, um, and really working at all levels from the federal down to the state level around higher education policy. And the truth is that our system is still very broken. College is still insanely expensive.
Insanely
Um,
inexpensive, yes.
and but it's still, generally speaking, a good investment. And so we have to make sure people have the facts so that they make good decisions when they're taking on loans, and that they know all the different options for repaying their loans. Because one of the things we realized when we started Savvy was there were programs that could reduce payments, could lead to forgiveness, but people didn't know about them and they didn't feel comfortable accessing those programs. So that was one of the big reasons why we started Savvy.
I mean, huge shout out for starting Savvy because student loan debt is astronomical in this country right now. You don't really think about it when you're taking those loans out because you just want to pursue your education and get there. So, how do you figure out how much to borrow? So, do you work with the student from day one on how much to borrow or just in that payback period?
Yeah. Well, first, just to lay the groundwork, so you're right. We're
Mhm.
nearing $2 trillion in
Yeah,
student loans in this
scary.
country. It is it's right up there with credit card debt as the biggest.
Mhm.
Mortgage is number one consumer debt, but credit card student loans are right there, number two. Um, there's about 46 million people who have student loan debt in this country. Average debt is over $30,000. So first thing I try to do with students or anyone who's taking on loans, it could be the parents, it could be older adults who are going back to school, is
Mhm.
just understanding how much debt they are likely to have from that program, and then translating that into, well, what does that really mean from a monthly payment standpoint? So if you tell me, oh, I'm gonna have to take on $50,000 for this program, you know, I'll say, that might be $1,000 a month in student loan payments. Just think about that in terms of, how much you're likely to pay for rent or other financial things. That's a pretty substantial amount. So you want to,
That's
when you
huge.
it's huge.
Yeah.
And what you want to do is make an assessment. The economists call it ROI, or return on investment, is how much is this career and this education likely to, advance my earnings and open up career opportunities for me that are ultimately going to allow me to make a lot more money over my lifetime, versus how much am I going to have to pay in student loans. And ideally, you know, in the long run, you are making far more than those student loans. But there is that, oftentimes, a short term, and not even that short term, financial hit where you're having to make those monthly payments. So first thing is just understanding how much are my monthly payments likely to be. And many people don't have any clue when they take on student loan debt what that translates into from a monthly payment
From a
standpoint.
monthly payment. Absolutely.
And I
And
understand, for an 18-year-old, this might be the biggest financial decision you've ever made in your entire life. So
absolutely.
it's not shocking that people don't fully understand all these details, but you really should. And if you're a parent, you really should make sure that you have all those sort of that full awareness when you're making a decision to take on that much debt.
Absolutely. And when you talk about the monthly payment, so you get out of, you get out of college and the student loan payments begin 6 months after you graduate,
Right.
considering you hit that defer until graduation button, because if you didn't, you're paying them while you're in school. So that's a little caveat there. But you get out and you get your first career, you're not making a ton of money, but that payment is due. So maybe 5 years down the road, you can afford that payment, but what do you do until you get to that point? So I don't know, maybe stay home, live with the parents for the first 2 years. And because that's the only time that you can actually save 50% of your income is when you're still living at home. So if
Yeah.
you could tackle those debts early on in those first 2 years post graduation, that might be helpful as well.
And that's what we see all the time. Maybe your first, you graduate, you're looking for a place to live. Maybe you have a roommate, or several roommates instead of just
Hmm.
getting that place on your own. Maybe that's a little farther down the pike when you have, your income will go up over time, but you want to make sure that you have enough income to cover those payments. The Some people don't understand other factors that you might look at are, one, there are programs called income driven repayment. So what that means is that typically you have 10 years to repay your student loans and your payment is set based on that schedule. But there is a government program where they will set your payment based on your income. And the idea is, if your income is very low to start out, which it often is, then your
Hmm.
payments should be low. And as your income goes up, you can afford to pay more, then your payments go up. That's a really important option. It's not, the only option, but it's a really important option for people who are just starting out. And what you don't want to do is get into default on your student loans. You don't want to say, you know what, I can't make those payments. I'm just going to throw my hands in the air, because what happens then is, A, the government can come after your paycheck. They can come after your IRS tax refund. The government's going to get their money, but you also might see your credit ruined. And then
Right.
you have all these other sort of implications. So you want to get on a payment plan for your student loans that you can afford for starters, so that you stay on track, and then you can think about how to pay more than that to pay it down faster. So income-based repayment, really important for people to understand. Um, Second thing is, depending on your career, you should have an understanding, are there programs that could actually forgive some of that loan? So there's a program called public service loan forgiveness, where if you work for the government, if you work for a nonprofit, if you're a teacher, if you're a
Hmm.
firefighter, all these different careers, there's actually about 25% of student loan borrowers fall into one of these categories. If you work for a
Wow, that's a
hospital,
lot.
you might be eligible to have your loans forgiven after a period of 10 years. And so what we see at Savi is oftentimes that could be well over $30,000 in loan forgiveness, forgiven, tax-free. But you have to
Hmm.
know about that program, and you have to get signed up, and you have to fill out the paperwork. And that's often what trips people up. But it is really, really important if you think you're going to be going into one of those kind of public sector careers.
And to your point, 25% is a huge amount, and not to be aware of that opportunity for you, or that option that you can pay it back and have it forgiven after a certain amount of time is a huge component. So you
Yep.
and your team work with the individuals and find out, like, well, what industry are they in, and look at all of those different things.
Yeah, exactly. So what we do is we typically structure Savvy as a student loan benefit for an employer. You can get it through a financial institution. We have a number of financial institutions who partner with us, membership groups, et cetera. First
Hmm.
step is generally you're going to come into our Savi guidance platform where we're going to get some information about you and be able to kind of crunch the numbers for you. Every person is different. You really need to have this
Absolutely.
you really need to understand your numbers as they're specific to you and your family. Then we lay out all you know, the repayment options, how much you're likely to have to pay each month, how you could reduce that. And that's generally all just free information for the users. The idea being we want to arm you with all the facts, and then you make decision about what's going to make the most sense for you. Some people say, you know what, I want to pay this debt down as fast as possible. I'm going to go above and beyond. Maybe I'm going to, you know, go even beyond what I feel comfortable with, but I want to get this debt done. And
Hmm.
other people say, you know what, this is a tough time for me. I want a low payment so I can just kind of get through, and I know in the long term I'll be able to pay more. Um, so that's step one. And then, you know, we layer things on top of that. So you can talk one-on-one to a student loan expert. Some of our employers do what's called employer contribution, where they're actually saying, we're going to help pay $100 a month to help you pay down your student loan. That's a great
I've
benefit.
I've seen
Um,
that benefit pop up more and more over the last few years, where employers are really feeling for their people and saying, hey, you know, they really need help. They already went to school and everything. So instead of them using our tuition assistance program to go back to school, we're going to help them pay down their student loan debt.
Yeah, it's a great thing. Like traditionally, if you think about the traditional benefit package, you've got
Hmm.
your retirement, you got your healthcare coverage. Those are great important benefits. But the reality for many, particularly younger employees, is they
Hmm.
got to pay those student loans right now. What are their main
Right.
priorities? Paying their rent, paying their student loans, you
The
know, and
car.
the
Hmm.
car, right, right.
Yep.
So like just immediate paying credit card bills, like those are immediate needs. And so seeing employers step up and say, you know what, I get it. I'm going to help you deal with something that's really pressing right now. And it has the tax benefits for the same tax benefit as the tuition reimbursement. So there's really no reason not to do it. We actually have started helping employers manage their tuition reimbursement program as well, because we see that program as a good benefit, but often underutilized and
Hmm.
often not well understood. So that's kind of how we deal with employers. We're starting to do more and more with colleges and universities. I think that colleges and universities don't do nearly enough to prepare students both for how much debt to take out and how to finance
Right.
education, but then what to do. You know, the reality is you had a great 4 years at your college. Once you leave, you're kind of on your own. Like they're not,
Hmm.
you know, they're supposed to provide some financial literacy information, and it's called exit counseling on your student loans, but it's often pretty minimal. So trying to encourage colleges to do more on that front and really set people up. So like you said, typically you'll have 6 months before you have to start making payments. Just figuring
Right.
everything out so you're
And in
on
6 months,
track.
your school email is gone too. So you
Right,
only have that
exactly.
school email for 6 months. So you need a real email, you need a real plan.
Exactly. And we see recent grads, they don't even know who they took out the loans from. So they don't even know
I
what
hear that
website to go.
often.
What website do I go to figure out who do I pay my student loans to? So you know, that's partially on the student and their family, but you know, you gotta take the time when you're in school to make sure that you're on track. But it is, to be fair, it's a very complicated process and they don't make it easy. And so Savvy tries to simplify it as much as we can. Again, give people the
Mhm.
options and let them make um, smart decisions. I also think that it is one of the things we point out, it's in the interest of the employer because when a recent employee, when someone graduates, they often will change jobs very quickly in
Yeah.
those early years. And one of the reasons is they feel this financial pressure. So, you know, if your employer is not, you know, presumably you might start at a lower salary, but they're not offering these benefits that kind of address those needs. That's one of the reasons why some of those younger employees are hopping from job to job. And so there's really a
And
retention argument for
absolutely
employers.
retention factor there, no question. Let me ask you this. So there are student loans that you get from the government, but I think what students also don't understand is that you can have an unsubsidized loan, a subsidized loan, then you can have a Parent Plus loan, and they all need to be paid back.
Right.
And they're all different. So you're getting money from like three different people, and where do you find that? So is my loan with ABC? Is my loan with Milnet? Is my loan with Mohila, or whatever the case may be?
Oh,
And they don't really pay attention to their school email to find out that information.
absolutely. And then you add some people have to take on private student loans. So you also
Yep.
might be paying back, um, you know, College App or, whoever the private lender is. And frankly, I think the private student loan market is going to increase over the next 10 years. Some of the policy changes, they're really trying to cut back on Parent Plus loans. Grad Plus loans are going to be eliminated. And partly, those loans have a pretty high interest rate. Parent Plus loans have very high interest rate. Grad Plus loans have high interest rate. Um,
Mm-hmm.
so I think there's been some sense of people taking on a lot of those kinds of loans that are not great loans. You mentioned the direct, loans, the subsidized and unsubsidized do have lower interest rates generally,
Mm-hmm.
than what you'll find in the private sector. But like you said, it's a real complicated mix where you're taking on 3 or 4 different types of loans, each with its own, repayment terms, interest
Yep.
rates, balances, and just so one of the benefits of Savi is just honestly getting all that information in one place. So we will sync your loans across all the different servicers that you might have
That's
so
great.
that when you log in, you can say, okay, I got, this much debt with these guys, this much debt with the other guys. And sometimes you'll have a strategy that says, okay, I want to pay off some of these loans first and because I want to get them out of the way. And then these
Mm-hmm.
other ones, um, I can treat differently. So for example, the federal loans are eligible generally for public service loan forgiveness. The private loans are not. So you might want to
Right.
think about, maybe I want to pay my private loans off now, but I'm going to actually work toward forgiveness of my federal loans.
Yeah.
So those are
And the
those are some of the strategies, people
and the
might think about.
subsidized and unsubsidized loans tend to be a little bit of a lower balance than the government or the private loans too. So maybe get the
Right,
smaller balances out of the way, things like that. That's
right.
great information. But it's just amazing how many people just aren't aware of what's available to them. So can you speak to the recent changes for the caps of student loans? And that literally just came out, oh no, a couple of weeks ago.
I mean, this is why it's so challenging, right?
Hmm. They
You
keep
know,
changing the rules of the
they
game.
keep changing the rules, and it's happened, frankly, in every administration. They change the
Yes.
rules,
Hmm.
and so you have to be like a student loan, a true policy expert to understand all the changes. So in the recent bill called BBB, they put in place these caps on overall how much you can take on in student loan debt. Programs like Parent Plus loans will have stricter caps.
Hmm.
Grad Plus loans, which obviously apply to graduate school, those are going to be eliminated entirely. So I would say for the most part, that bill had the biggest effect on graduate programs. So if you're like I went to law school and I took out a ton of grad plus loans.
Hmm.
Um, I wouldn't have that option in the future, which means that assuming this law school is not going to magically lower their
Hmm.
tuition, which they're probably not going
Same
to
for me.
do,
Same for me. I did
uh,
my MBA and my PhD, grad plus loans.
right? So
Hmm.
a person in that situation might have to rely on a private lender to come in and fill that gap. Private lenders, oftentimes there's a cosigner on the
Hmm.
loan. They don't obviously have some of the same federal benefits. Um, But that's going to be the reality. I think people are just going to have to make a determination on how to finance that. Most of those changes take effect next year. So, for the current borrowers, you know, July 1, 2026, or for future borrowers, that's really when a lot of these changes are going to take effect. And we're going to be doing a lot from Savi's perspective to try to educate, our users, our clients, the public at large about all these changes. But again, I think the biggest implication is grad school, the
Graduate.
way that we finance grad school is going to change, and people who have that intention of going to graduate school. And we know, more and more careers are requiring those graduate school programs.
Exactly.
And that's honestly, that's another thing that I think about. I'm also a parent of young children. I
Hmm.
know your kids are in college or graduating from college. Like I'm some years away from that. But now,
Hmm.
as I think about saving for my own kids, I have to think not
Yeah.
only about undergrad, but what if they want to go to grad school, or what if that's sort of necessary in their
Oh,
field.
I did tell mine if they want to go to grad school, they better be getting a full ride because that's not going to be on me. Just saying.
Right. Well, and it's similarly, like I was, I was on the hook for grad school, but I think that sort of mindset's gonna have to evolve over time as our education options change, and as the workplace changes. But yeah, to the original point, policy's always changing. We do webinars every single month for both users and for our clients about policy changes, to make sure that they're fully aware of what's happening, so that they can, in some cases, take advantage of new benefits.
Absolutely. And I think it's also going to change the landscape over the next 10 years of where these students over the next 8 years decide where they want to go to school. Do they want to do a 2 year degree? Do they want to go to community college first, keep their money down, then transfer into a 4 year school, maybe go to trade school? So that's going to change that too.
Yeah, yeah, absolutely. I do think that, the growth in student loan benefits at the employer level is an exciting development, and something that I'm really encouraged by is that, and I think, frankly, that college grads are going to start taking account of which employers have a student loan benefit program and which don't, and that might impact, the decisions that they make. So hopefully we continue to see innovation like that, to address the needs of grads.
Yeah, I think it's going to be a huge change and a huge shift. Anything else you want to add? And please let my audience know where they can find you and find out the information from Savi and the webinars.
Yeah, so the Savi is the company. You can find us at www.bysavi.com. You can also email me at aaron@bysavi.com. We typically partner, like I said, with all different types of entities: employers, universities, financial institutions, membership groups. So if you're affiliated or working for or a student at one of those types of entities, and you think, hey, they really should bring this benefit to the population there, we would love to have that conversation. Also, just happy to talk about, people's unique circumstances, and provide any information that I can that would be helpful. So yeah, really appreciate the time.
Yeah, I mean, and to your point, it's definitely not a one size fits all. It's every individual situation. So, not one size fits all for anything. You can visit my website, set up some time with me to help create a personalized action plan based on your current financial situation. So be open to learning, be open to listening, ask questions. What more do you want to know? Visit my website, send a question or a comment. Remember, be invaluable for what you share, not what you know. See you next time on your 18 Now What, where you can always find the latest podcast to listen to, follow, share, and subscribe. Thank you, Aaron, for joining me. I appreciate you.
Thank you.